Hello YouTube. Hope that everyone is doing well. And on my side, I'm doing well, except the cold is getting to me. I think I'm having flu right now. My nose is a bit stuffy, but my voice is clear, right? Anyways, Stepnex has been wonderful. It delivered the buy-side liquidity pool that I had spoken about, right? We were looking for these relative equal highs to be a draw on liquidity, right? So how would you have participated in going long, perhaps after the sell side liquidity had been taken, and you know that you have a bullish bias to run to these buy side liquidity pools? How would you participate in that setup in reaching these highs? There are a lot of ways to skin a cat. If you're looking at a model from the hourly time frame, and you chose the 1 hour time frame because you're best suited for this time frame, right? I've been showing you the 1 minute time frame, the 15 minutes time frame, which is the bellwether time frame. We had identified those key PD array, which is a parcel liquidity pool on the 15 minutes time frame. But now we've transposed the very same framework to the hourly. Well, on the 1 hour time frame, we have transposed those lower time frame key PD arrays and transposed them to the hourly, right? So the hourly time frame has its own structure. We have 60 minutes of a fair value gap to be printed. If we are looking for a particular model, then we have to submit to time, because these inefficiencies on the hourly time frame, they take an hour long to form. Well, you need patience. Eventually, you're going to submit to time, right? Whatever frame that you're trading, you're going to submit to time. If you're on the 1 minute time frame, you have to wait for those 1 minute candlesticks, right? If you're on the 15-minute time frame, you have to wait and submit to time. 15 minutes for your fair value gap to form at a particular time of the day. So we are technically transposing our what time frame inefficiencies or structures into the hour time frame, right? Now, as you noticed, we are now talking about market structure now. Things are getting dangerous now. I'm kidding, guys. Man, I'm having fun producing these videos, honestly. It's really something that I look forward to. But then life happens and I'm not able to produce any video, right? They take the electricity, right? And I can't produce anything because we don't have a generator at the moment. So yeah, it is what it is, man. Life sucks at the moment. But anyways, we had the Wednesday's price action here, delivering our move to the upside. Now, as I asked the question, how would you participate if you knew that price action is going to retrace back into these relative equal highs? How would you do it? Well, I just spoke about the 1 hour, which we have to dive deep into the 1 hour just in a moment. But then you got the 15 minutes time frame. You have to be a day trader to be looking at the 15 minutes time frame, right? If you're looking at the 1 minute time frame, you got to be a scalper. So each time frame has its own personality. So which one of these time frames do you identify with yourself? Which one is easier to trade? Okay, I'm best suited for any other time frames. I can trade the monthly, you can trade the weekly, the daily, any time frame I can trade. Well, that experienced, you may not be that experienced to be looking at the market the way that I'm viewing it, right? So you would not be well versed into the ICT community because we're talking about a different language, and we are calling certain price runs high resistance liquidity runs, and low resistance liquidity runs. What is a low resistance liquidity run, by the way? A low resistance liquidity run would look like this: price action moving away really quickly, right? It leaves this inefficiency. So that is a low resistance liquidity run. Price is drawn into this low. Remember that? That is the Tuesday's 10 a.m. low. I spoke about it, and we reversed, printed these relative highs. Then we burst lower quickly. What did we leave when we bursted to the downside? We spooled. We were rushing. That is low resistance liquidity runs. Price is in a hurry, and it often leaves these inefficiencies. So what is this inefficiency? It's a new day beginning, right? It's a new day beginning of an inefficiency. When the new day begins, it leaves these types of inefficiencies. Sometimes it does do that. It does do that. It leaves inefficiencies just when the new day begins. It's rushing somewhere. For whatever reason, we don't know. So it's a price signature that I've observed for a while, and I talked about it a lot in my previous commentaries last year. I spoke about it. When the new day begins, what do we expect? Price to run, especially if there is sell liquidity. So this is a low resistance liquidity run. What is the opposite? What is the high resistance liquidity? It's price action moving like this. It's consolidating. It's moving in a manner that is not enticing for you to trade. Would you be comfortable holding price if you had longed around this inefficiency here? Because now we would be looking at this inefficiency not as a resistance, but as a support. Since we've traded above the inefficiency here, anytime we come back into it, we want to treat it as a support. So we have three key levels. We have the fair value gap high, the consequent enrichment, and the fair value gap low. Each of these three levels has a significance on how the market behaves because it tells us the order flow. So as long as we are above this inefficiency consequent enrichment, I am permitted to look for long opportunities as long as price is above that consequent enrichment. So as long as it's printing above this fair value gap, I'm going to be bullish, and I'm going to be attacking that 7,690 again. That is where I am targeting, and I want to go way higher, way higher. So this is a swing trade. All right, we are looking at the 1 hour to frame how price action can go up in a swing trade manner, right? So the contrarian trade setup has this type of, well, price signature to it. If it supports on this fair value gap, utilizing it as a stepping stone or as a foothold to send price higher. We can look at other PD arrays. We have two forms of a fair value gap. Well, we have many, actually. We have many forms of fair value gaps. We have breakaway gaps, which I explain what is breakaway gap. It is price action leaving an inefficiency open like this. So this is the hourly time frame breakaway gap. It leaves this inefficiency. So breakaway gaps are associated with a gray color. Anytime you see a gray in my chart, just know that it is a breakaway gap. So we break away at what particular time? Look at your time. It says the 10 a.m. What is that 10 a.m.? It is New York. New York session is moving, good people. It's printing these breakaway gaps, and I love them. So this breakaway gap was very telling as to what price wants to do. It printed this market structure shift, and I showed you a whole lot of market structure shift on the upside on the 15 minutes time frame. But now we are transposing that in the hourly time frame, right? So on the hourly time frame, how would we describe a market structure shift? Well, my market structure shift is associated with this particular fair value gap because it's a bearish inefficiency. If I see price action trading below this inefficiency, then I'm likely to anticipate bearish setups. But if price action is disrespecting this as a bearish PDR, meaning that we are trading above it, we want to see price action treat that as a support. That is pretty significant because we are utilizing a timed based inefficiency, which is the new day opening fair value gap. So I'm gonna take my events and go to session breaks to show you that around this particular time, this is the new day beginning, which has a fair value gap. So we are just utilizing that fair value gap. I used to call that fair value gap the new day fair value gap. If I was on a weekly time frame, I would be observing that very same fair value gap, but in a 4-hour time frame fair value gap. I would call that 4-hour time frame fair value gap, right? New week fair value gap. That's what I would call it. Since we are on an hourly time frame, referencing the new day beginning, which begins around 7 o'clock in New York time, that is 7 o'clock, opening a new day with a fair value gap. So we are utilizing that fair value gap as an inverse. It's an inverse fair value gap, and we need to see price action respecting that. And we have this breakout gap. That was a beautiful price signature. As long as we are above that fair value gap, we are good for longs, and the buy side liquidity is way up here, 7,690. That's where I believe price action should be above right now, trading higher, screaming higher, and leaving a lot of these breakaway gaps to the upside. So let's go into the lower time frames. There are some price signatures that I want to show you. Step index on a 1-minute time frame. We are looking at the Tuesday's price action on the 21st of July, where we had that consolidation. So if we are transposing the hourly and 15 minutes down into the 1-minute time frame, we want to be utilizing structure that is suitable for the 1-minute time frame. The hourly inefficiency that we had that was printed in Tuesday, this was the hourly inefficiency when it was being printed for us to confirm a certain bias for a session. So we would need fair value gaps that can confirm what price is doing at the current session or at the time that you're looking at the marketplace. So I introduced the London session opening range, New York session opening range as well, and the PM session, right? So we had the Tuesdays first, 7 a.m. to 7:30, which is the opening range. It's 30 minutes. This is the narrative on the 1-minute time frame. We utilize that inefficiency as a support here, and we went higher, printed those relative equal highs, right? Remember those? We came down lower, printing the 1-hour time frame fair value gap. And look at what we were utilizing as our 1-hour time frame fair value gap low. We were utilizing the 7 a.m. of Tuesday's fair value gap as a result of this to send price lower into this 10 a.m. sell side liquidity, right? So on a Wednesday, we had the 1:30, which is the London session. This should be in green color. If we are talking about the London session, then it should be in green. So this was the fair value gap that was printed in London session. As you can see, we are way below the 1-hour time frame fair value gap. So the 1-hour time frame fair value gap is a PD array. I think this is a key PD array, and we're gonna utilize the key PD array in reference to what price action is currently doing. So we identified this breakaway gap. It was near the 1 minute time frame London fair value gap. It printed that it broke away from that particular London setback. Price action was kind of like resisting initially. 10 o'clock hour is really powerful, beautiful people. If you have 10 a.m. with the ability time frame as a fair value gap, then these are the results that you're going to see. Price action moving away quickly, right? It's rushing to get into that 1 hour time. So remember what we had with the New York session, opening range, fair value gap on the list. We had that printed the 1 hour fair value gap low. So that is a pretty significant key support. We utilize that as a support, right? We hammer it down with a support. So at the 7 o'clock, we've begun a new trading day. The new trading day, guys, does not open at the 5 o'clock. I don't know what Deriv and TradingView are doing, but they are messing up my charts because I'm having a difficulty in explaining the time and price theory coined by ICT. Why are they dilly-dallying with the opening price of the day is? Because on TradingView, it says that it is at 5 o'clock. That's where the new day begins. But in Deriv TradingView implementation, the new day begins at 7 o'clock. So at 7 o'clock, as you can see, we are trading above the consequent enrichment. If we are above this key PDRE, we are permitted to call longs, beautiful people. So we utilize that today. On Thursday, we support on that and we go higher to 7,690. That was beautiful. So that's how you would have participated your beautiful setup in reaching that price level, which is relative equal highs. That's buy side liquidity. So you see how you can utilize the 1 minute time frame inefficiencies. This was a beautiful support. So I'm going to transfer into the PM session of today. PM session. We want to see how price action performed around the 1 hour time frame inefficiency. Right? This is what we trade, beautiful people. We want to see price, but first we need to see time. So it is time first. So here is time. At 1:30, looking for an inefficiency that is bullish. Because why? We are bullish. We are anticipating that the 1 hour time frame fair value gap is going to support price action and go higher. So here is 1:30 right there. 1:30 is right here. It begins with a fair value gap. Now the fair value is a PM session fair value gap. So we're going to associate that with a yellow color. It's a bit hue. Let me just increase that so that it can be visible. So we support it at the upper quadrant of that hourly inefficiency, right? So we printed an inefficiency at a key particular time of the day. We are making a market structure shift here. As you can see, price action was bearish, 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 right? We got below the 1 hour time frame, consequent enrichment. But what price action was actually doing was rebalancing all of this inefficiency. Price went parabolic higher at the 11:30. You know 11:30, what is that? It is the New York session lunch. Right here, it goes up. It's retracing against everybody who has profited the market at the 10 o'clock. 10 o'clock hour would know that is the New York session second round of news. But here in StepIndex, it prints certain highs and lows. Now, this is our 10 a.m. high, which is basically buy side liquidity. Okay, so we're going to have a darker color because that is buy side liquidity. And look what is near that buy side liquidity. It is 12 o'clock. 12 o'clock high is a pretty significant high as well, because that is lunch. Lunch highs are situated with the 10 a.m. highs. That is suspicious. So we go lower, we rebalance the inefficiency, we hit the bullish order block. So the bullish order block here, we're going to associate that with a very light gray color, right? We are printing inside of that bullish order block. We support on that and we go higher, parabolic higher. So we are continuing the momentum that we had in the beginning of the New York lunch. And we are doing it around a certain time of the day, which is the 1:30 p.m. session for Everly Gap. So we supported on that. That could have been a beautiful long opportunity right here. And you would have of a stop loss. If price action below the cost management here, you would be in trouble. But essentially what you're doing, you are tagging those relative equal highs. So we know that section could go for these 7,690 level. So that would be about 20 points. Beautiful setup. Beautiful setup, beautiful people. So I'm going to leave that running, right? I'm going to leave that running to potentially attack those buy-sell liquidity pools. So that could be a setup that you could partake on the 1 minute time frame. Or you could leave price action running, leave your trade setup just like this, and anticipate that the 15th of July is going to get hit. It will be a swing trade. How much is the stop loss? It's 30 points. 30 points. If you're utilizing the lot size 0.10, 30 points is $3. So if you're utilizing a lot size, let's say 0.20, you double it to $6 of a stop loss, right? The more you double it, it increases in value. So your stop loss would be larger than it needs to. So you need to utilize proper risk management for these types of trades, right? No need for you to barcode, buddy, because this setup occurs many times, many times of the day, around specific times of the day, of course. We are talking about time. Time is important, because without it, I would not be trading. Honestly, I would not be trading, because I would not be able to observe certain algorithmic price signatures at certain times of the day. So we have that PM session fair value gap. What is it doing? Creating a market structure shift where above the hourly time frame upper quadrant. What is that? It's bullish. Why is it bullish? Because we want to get those relative equal highs up there, right? 7,690. That's where we are going. So we need to be familiar with the 1 minute time frame, key structures, which is timed based inefficiencies on the 1 minute time frame. We associate that with the opening ranges. It's 30 minutes that could change your life. Honestly, man, because this is a swing trade, but we are transposing it in the 1 minute time frame. Let's look at the 1 hour time frame and see if we are indeed respecting the consequent enrichment, that hourly consequent enrichment. We are good for lots. So here it is, step index on the hourly time frame. We are bullish, good people. We are bullish, extremely bullish, if we are above that hourly time frame consequent. So this is the lowest hanging fruit objective that you target. But I'm really aiming for that. That is the 15th buy sell liquidity. That is a timed based liquidity pool. And we are climbing that mountain. We are climbing that mountain. We are ignoring any type of shorting scenario up until we hit that buy sell liquidity pool. Okay, it's pretty basic rules. Ignore selling opportunities up until we hit that particular key level. So that is the market maker buy model. This is a key PD array that we want to attack. So I'm going to put away the session breaks because they are getting into my nerves. Okay. So we have all of those buy-side liquidity pools up there at a timed by schedule. It's the mid-month trading back into this particular range. So we have the consolidation here, which is the original consolidation that you guys are familiar with if you are trading ICT market maker models. So price action returns back into the original consolidation at a particular time of the day or the particular time of the month, which is the mid-month, right? So in the heart of July, we print that particular high and we drop lower aggressively to attack this particular liquidity along with the general low. Remember that we attack that, right? So at this particular time, we are anticipating that the market will want to reverse and go higher. And these are price signatures that we are looking for. Breakaway gaps, inefficiencies that are bearish turned into an inverse going higher. So that's what I would love to see, beautiful people. So until then, we will let time do its work. I will see you guys on the next video. Hope you enjoyed this one.